In exercise 520, we are looking at prepaid rents. And I want you as students to realize that often office space and warehouse space is rented almost on a 6-month basis. So there are many journal entries that I've run into as an auditor that have prepaid rent for sometimes up to 18 months. So this problem is not unusual. This is something that you'll run into. Situations that high rent districts or high demand warehouse districts will rent their spaces for a very long time and expect prepayment up front. Sometimes you'll have a long-term lease of 10 years, for example, and you'll have to pay 18 months up front. So these journal entries are not unusual in nature. Just wanted to run by the first one here, which is November 1st. You paid the prepay amount, which is $3,100 and $800. So remember, you record that as a prepaid, and that prepaid amount is an asset to you because it has future benefit for you. So we record it as future benefit until, of course, it decreases in the amount of the prepaid as the periods roll by. Now, very often, companies will make a journal entry at the end of every year, every month to adjust prepaids. But in this particular case, I think they ask us to make an adjusting entry that would be every month, right? So, at the end of each month, we would then take this 31,800 and divide it by 6, and we would do a journal entry for $5,300 at the end of November, and then we would do that again at the end of December. So as of December 31 here in C, you'll see here 2 months of the prepaid rent has expired, and then 4 months remains unexpired. So that means, guys, that the remainder of that prepaid for 4 months is going to show up on your balance sheet as a prepaid expense. Okay, I mean prepaid rent, excuse me. It's going to show up under assets. But that amount is not going to be 31,800 because you already decreased it by 2 months worth of expense and you credited prepaid rent. So now the balance in it is 21,200, and that's the amount that would be in it and included as a current asset in your financial statements for the end of December 31, 2019. Now, the D kind of throws a wrench in all this. It says, forget about how much you prepaid initially at first. Let's just say that the prepay was $5,300 a month, but it was 18 months and not 6 months. Okay, so if it's an 18-month prepayment, it would have been $95,400 would have been the amount that you're prepaying up front. But then it would have been decreased by 2 months as of December 31 because that would represent 16 months. Okay, but only, remember, 12 months of that would be considered a current prepaid amount. So it would be a current asset for 12 months. But remember, you got 16 months. So 4 months of the 12 months that you have in prepaid very well could not be listed as a current asset, but would be listed as a non-current asset in a separate account. I'm just letting y'all know that if you want to be particular, these definitions of what is current and non-current is all the author is trying to do here in D, is to get you to see that If something extends out beyond 12 months, it very well not be in a current category. Now, I'll tell you this, though, guys, just as a practical matter. If you had a prepaid that went into 4 months of the next year, you probably would not separate that and put it as a non-current asset. If your company's doing any volume at all and it's $5,300 a month, you would probably just leave it in current. But this author is really trying to, in this problem, get you to see that some of this may not be current. And remember that some companies pay literally millions of dollars in prepaid rents, and so the current non-current amount could be something substantive and substantial to some of your liquidity ratios and calculations of financial statement analysis. But anyway, so that just kind of shows you the calculations here for that, and I just wanted to verbally kind of talk you through that a little bit, and just let you know that current versus non-current is kind of a distinction in this chapter. So hopefully that'll help you with that.